Hello, everyone. This is Assemblyman Ron Kim. I'm joined by Bob HOCKETT. If you're joining us on Zoom and you are part of the press, if you can just keep your uh, phone on mute and video off while we get through the presentation, and we'll be more than happy to answer your questions at the end. For those that are tuning in on Facebook, YouTube, or Twitter, we're monitoring all the questions on those platforms as well. So if you ask, we have staff members that will bring those questions onto the Zoom room as soon as possible. So in early April, as soon as we heard that the Federal Reserve Board was introducing new access to money for localities and states by creating the Municipal Liquidity Facility, or the MLF, Professor Bob HOCKETT from Cornell University and I sent memos to the governor, the mayor, all electeds and commissioners overseeing the financing duties in New York, explaining what's happening and why we need to end our austerity mindset once and for all, and why it would be absolutely reckless, and I'd even say, foolish and unnecessary to continue cutting essential programs during a pandemic. Yesterday, we had a grassroots press conference that included, I'm sorry, if whoever is, okay, I will mute that person. Thank you. Sorry about that. Yesterday, we had a grassroots press conference with Make the Road, Vocal New York, and a number of groups that included this as part of the reason why the governor should not be cutting $10 billion during this crisis. He said he proposed that cutting over the weekend, so we immediately pushed back to tell the governor this is actually not necessary to do that. Michael Kink from Strong Economy for All and Marcus Stanley, our financial security, were extremely helpful in advocating for the terms at the Federal Reserve, and they were also there yesterday explaining to the public what's going on. Today, the objective of this press conference is to give some background on what this new money is about, which is roughly about $20 billion for the state of New York, and what we must do to secure the $20 billion. So, with that, let me hand this over to officially start this press conference and hand it over to Mr. Bob HOCKETT. Bob, if you can start off by telling the audience and the press who you are, what your background is, and why you're so focused on getting this right for our state of New York.
Definitely kind of missing the city right now because I feel a bit, irresponsible in the sense that I'm kind of lucky to be out here in upstate when other people are sort of much more densely packed in the city and suffering in consequence. In any event, my background is in finance and financial regulation, and or I should say, previous jobs that I've held, some of them before working at Cornell and others concurrently with Cornell, include stints at the New York Fed, which is a particularly important institution for present purposes, on the one hand, in the International Monetary Fund on the other. So I have a long-term interest in Fed matters, things that the Fed does, and the various promises that can be, or the promise that's offered by monetary policy and monetary policy innovations in particular, and central bank policy innovations in particular as well, when it comes to handling social problems of various kinds that we haven't figured out other ways of handling. So that's sort of my background and sort of the background of my interest in this. I guess I should note also that I've got a long background in community finance efforts. About 10 years ago, I got a bit of attention for an eminent domain plan for underwater mortgage loans that I was behind during the worst of the housing crisis and the mortgage crisis. And that too was about communities, or was community oriented. So the interest that I have in community QE, as Ron and I have been calling it, as now offered by the Fed, I think sort of stems from that background, activist background, as well as the academic and vocational background. Now then, straight over then to MLF, to the Municipal Liquidity Facility. A couple things to say about this right off the bat. The first is that it's quite unprecedented. It's brand new. The Fed has never done anything quite like this before, which makes it then all the more important that we get the news out as quickly as possible and as widely as possible to all relevant city officials and state officials, because they're much less likely to know about this as a prospect than they would otherwise be, precisely because there's never been in the past any reason for them to be paying close attention to policies of this sort or programs of this sort that have been pursued by the Fed. Second thing to note then is what it actually is, what it actually bodes, or what it promises. So an easy way to think about this, or a helpful way to think about this, is if you go back to 2008 and 2009 and remind yourselves of the various facilities that the Fed opened up in order to rescue large financial institutions, notably banks, but also other financial institutions. And then just think about the current plan as an attempt essentially to adapt that structure that was pioneered 10 years ago for banks over toward helping communities, to helping cities and states, and bailing them out in sort of the same way that it aided large financial institutions about 10 years ago. That will give you some sort of an inkling as to what the significance of this is from a policy point of view, but also from the point of view of the promise that it offers. So when it comes to that particular promise, in essence, what the Fed is telling us it intends to do is to aid cities and states that are having trouble basically maintaining their budgets and maintaining their finances as they address the pandemic. The challenge, as you guys doubtless know, that the cities and states are facing right now is that on the one hand, traditional sources of city and state revenue are drying up, right? Sales taxes are down, property taxes are down, other sources of sort of short-term, medium-term revenue have been dwindling, precisely owing to the shelter-in-place measures and the social distancing measures that the pandemic has necessitated. So that sort of diminishment of revenue, on the one hand, is happening sort of ironically at the same time, of course, that expenses are rising for cities and states as they address the pandemic. And we're faced with the situation where, sort of ironically, cities and states are having to fill in for federal agencies that just aren't doing the job in the way that they used to. So one way to think about what the Fed has decided to do here is that the Fed is sort of recognizing that cities and states are the new federal agencies that basically they're filling in for, or doing the jobs that federal agencies used to do. And so they thought, well, as long as these city and state instrumentalities are doing these federal jobs, or basically fulfilling these federal tasks, we should fund them like federal agencies. We should make federal funding available to them on generous terms. So in effect, then, what the Fed is doing is it's saying that, look, various financial instruments that cities and states traditionally sell on the so-called muni markets in order to raise money, right? Various financial instruments that they typically monetize in order to keep financing coming in are going to be bought abundantly now and directly for the first time ever by the Fed on very favorable terms, on terms that are very favorable to the cities and the states. Furthermore, the terms of these particular the terms of the program are very generous by Fed standards, and are furthermore sort of widening or broadening or becoming even more generous as time goes on. So some of you who've been following this stuff might remember that just a few weeks ago, Ron and I were noting that the instruments that the Fed was going to buy included instruments of 2-year maturities, 24-month maturities. And we noted at the time both that was double the the length or the duration that had been anticipated. Back in March, people were expecting that these would be 12-month instruments. And so announcing that they would be 24-month instruments right from the get-go was itself a very important sort of change. But Ron and I were also predicting 3 weeks ago that they would probably be extending these terms outward, basically making them of even longer maturities going forward. And the announcement yesterday that they're now already extending out to 36 months.
Okay.
Instruments or corroboration of exactly this prediction that Ron and I made 3 weeks ago. Another prediction that Ron and I made 3 weeks ago was that while the program, as initially introduced at the beginning of April, was going to be limited to states on the one hand, and then cities with 1 million or more residents, or counties of 2 million or more residents on the other hand, we predicted that they would basically lower those population thresholds going forward. And we thought that they would probably lower them to at least half fairly quickly. Well, yesterday they one-upped us. They actually moved forward even more quickly than Ron and I had predicted, because the threshold for cities is now 250,000 rather than 1 million, and rather than 500,000. And the threshold for counties is 500,000 rather than 2 million or 1 million. So the other thing, of course, that they did was that originally the window was going to be open for the sales of these instruments by cities and states to the Fed until the end of September. And we predicted, Ron and I did 3 weeks ago, that they would probably basically keep that window open longer as well. And once again, yesterday, they corroborated that prediction. It's now going to be open until the end of December. So what that means is that for the remainder of this calendar year, cities and states will be able to issue new instruments that they can immediately monetize with the Fed. That is to say, convert into cash. They can be longer term instruments. The term sheet also opens the door to possible rollover even 3 years down the line. It also keeps the door open to even longer term instruments going forward, like including 5-year instruments, which some analysts have predicted and have called for. So in effect, what the long and short of it is that the Fed is sort of saying that, look, we've got your backs, cities and states. You're going to have very cheap funding from us. You can put off for as long as it ends up being necessary, any kind of paying back. We want to make sure that you are fully financed in handling pandemic relief, since you are basically the only game in town now, given the fact that, again, federal agencies are just not doing that job anymore, and it seems to be falling on us, the cities and states. So I hope that's at least a helpful sort of introductory or opening gambit, Ron. We can get into more detail, of course, if you like.
Thanks, Bob. So I think for the general public, when they hear words like instruments and term sheets, I think a lot of us, our filters go up and we tune out.
Yeah.
So let's take a backtrack. Quantitative easing and monetary easing. What exactly is it in simple terms? And what happened 10 years ago? And what was the outcome when the central banks were given near zero, below zero interest rate loans? And what happened? Was it a successful outcome? Did that money trickle down to the localities? Did the small businesses get bailed out in the process? So can you answer those questions for me, Bob?
Yeah, sure. So here's a way to think about it. When the Fed buys instruments of this kind, what it's effectively doing is swapping money, or basically legal tender, for paper obligations that don't count as legal tender, right? So if you take out a dollar bill from your pocket and read across the top, it says Federal Reserve Note. It's effectively an IOU that's issued by the Fed, and that's the form that our currency typically takes. And thanks to legal tender law, that counts as money. So basically, anybody you want to buy something from is required by law to accept a Federal Reserve Note, that particular form of promissory note, in payment of any particular obligation that you might have when you're buying something or paying your rent or paying your taxes, of course. The rest of us issue paper as well that we call IOUs or promissory notes when we take out bank loans, for example, and the like. But our notes don't count as legal tender. We can't spend them. So when you borrow money, what you're basically doing is temporarily swapping your own IOUs for the Fed's IOUs. That means in turn then is that anytime the Fed broadens the eligibility of the IOUs that it is willing to swap its own IOUs for, that is to say, anytime it broadens the window to more and more things that it's willing to buy, that is to say, trade money for, you're basically engaging in a kind of, you're basically seeing the Fed engage in a kind of monetary easing. It's trying to make money more widely available so as to basically buttress or maintain people's purchasing power, which is a prerequisite to continued economic activity on the one hand in the private sector, but also a prerequisite to continued public sector functioning on the other hand, because when the public sector is functioning, it's doing that largely by paying for things, right? It's either paying its personnel or it's buying equipment, for example, ventilators or the like. All of the things that cities and states do, they pay to do, and they need money to do that, and they're not allowed to issue their own money in the sense of legal tender. So in order then, basically to ease the spending, to enable cities and states to spend more to do what they're having to do, what the Fed does is it says, look, there's a greater variety, there's a larger number of IOU types that you cities and states might issue that we're willing to trade for our IOUs, which again are dollar bills, basically, colloquially speaking, right? So they're willing to monetize more in order to make money more widely available, and that's why we call it easing. Now, going to the other part of Ron's question, back in '08 and '09, the Fed did precisely that for various large financial institutions that were facing what was called at the time a liquidity crunch. Basically, they were short on short-term, they were short of short-term money. They didn't have the money that they needed to pay their immediate obligations, to pay their sort of short-term bills or even their medium-term bills. And the Fed sort of recognized that most of these institutions are fundamentally sound, right? In the long term, they're fine. But in the short term, they're not able to pay their bills, and it would be a shame for these institutions to fail and go under forever simply because they can't pay their short-term bills owing to a temporary crisis, a temporary liquidity crunch. Now, the Fed was sort of largely correct about a lot of that, but it was sort of correct, it was sort of too correct by half in a sense. It turned out that a lot of these financial institutions were not only, fine for the long run, but they were probably doing all right for the short run as well. They didn't need nearly as much of the bailout money as the Fed provided to most of them. And in consequence, most of that bailout money, or at least an insufficient amount of that bailout money, trickled down to people like you and me and to small businesses and the like. The banks and the larger financial institutions spent a lot of that money speculating on commodity markets, basically driving up the prices of foodstuffs and fuels and those sorts of things back about 10 years ago. So there was one line of criticism that was launched against QE of the sort that was pioneered in '08 and '09, was that it basically just inflated the prices of commodities and foodstuffs that people like you and I have to pay for. So in a certain sense, it was actually harmful to a lot of us, even while it was being helpful to these institutions. And insofar as the institutions were spending the money in that way, they were in effect proving that they didn't need the money in the first place because they weren't using it so much just to pay bills, they were using an awful lot of it to speculate. So a charitable read on what the Fed is doing this time is it's trying not to repeat that error, at least to the same degree. Now, it seems to me that to some degree it is already being repeated because we're already hearing stories, right, about larger firms that are not hurting at all, getting an awful lot of money that was originally intended to help out small businesses. So I don't want to suggest by any means that the mistakes of '08 and '09 are not being repeated. They most definitely are. But the one thing that we can add this time that we couldn't say back in '08 and '09 is that at least the Fed is trying directly to assist the states and the cities who really, really need this funding now. Because again, as Ron and I have noted over and over and over again in recent weeks, and actually over the last couple of months, is that the cities and the states really are our prime line of defense. They're basically handling most of the pandemic relief. They're handling the testing, they're handling the treatment, they're handling the shelter-in-place rules and the enforcement of those rules. They're basically doing everything that federal do, and that's of course very expensive for them to do. So they're running out of money, even though they themselves are in the long term fundamentally sound. It's not like our cities and states are crazily profligate and constantly getting themselves into trouble. They usually do a lot better than our banks do, actually, in normal times. But of course they're doing worse than the banks are in these non-normal times because the banks don't care about us and they're not doing anything to help us in the midst of this pandemic, but the cities and the states are. And the Fed, to its credit, I would say, in this case, is noticing that and saying, all right, then, we're going to get all the money that you cities and states need to you for the duration of this. We're going to do whatever it takes for as long as it takes.
Right. And Bob, you've, and along with many others, have predicted a recession was going to happen again after 11 years ago. So I know our counterparts in London, they've been pushing for a green QE, and you've also been one of the very few people in this side of the world that have been focused on, well, we can't do what we did last time, so let's figure out a better model when the recession hits. But obviously, no one could have predicted the health and economic crisis, the supernova meltdown that we're facing now. But having said that, I think you already covered this, but the community QE that we coined, what is the big difference between the previous model and versus the community-driven model that the Federal Reserve has set up? And secondly, I think for the general public that are just reading the papers and reading and just tuning in, they may be confused about, okay, the Fed, we hear the Fed, is that the federal government, is that the White House, or or is it something else? Is it, what is the Federal Reserve versus what we're hearing from the White House, and why is it so important now more than ever to have a full understanding of the difference between what we're hearing out of the White House versus what the Federal Reserve is doing?
Yeah, so a couple things then. First, on the community side of things, and the difference between the sort of community focus of community QE, as we the term that we coined for this together a few weeks ago, on the one hand, and earlier forms of QE on the other, is that the Fed is sort of focused on public sector institutions, for one thing, that need assistance and that need basically full financing, rather than focusing entirely on private sector institutions, and maybe even more particularly financial institutions of the kind that it focused on 10 years ago. So the fact that it's focusing on the public sector is itself colossally important. That's the first time that this has happened. And then second, the fact that it is sort of small scale or sort of lower level public sector institutions or entities that the Fed is sort of looking at is very important here too. And in this connection, I think it's exceedingly significant that the MLF, the Municipal Liquidity Facility, as it's officially known, is looking not only to states but to cities. And the thing that really is distinctive is that it is ready independently to fund cities, even apart from their relations to states, as long as they meet those particular thresholds, right? So in other words, the city of Atlanta in Georgia independently qualifies for Fed assistance in meeting its particular financial needs while it's addressing the pandemic as manifest in Atlanta, quite apart from the state of Georgia and whatever the state of Georgia needs and receives from the Fed. That can be very important for a couple of reasons. One is that some cities are disproportionately hard hit. They're hit more than other cities within their same states are. Furthermore, some cities tend not to be as carefully looked after by their states as other cities are, particularly if they're cities with large populations of folk who are not just like white males who are in the upper middle class, right? So there are traditionally, you can think of a place like Flint, Michigan, for example, if you need a kind of a poster child for this, right? It's very common for some cities or some localities to be sort of disproportionately unattended to or insufficiently attended to by their state governments. And so the fact that the Fed is willing to aid cities directly, in addition to their states, is also colossally important, especially now that that threshold has been dropped down to 250,000. Because now in the state of New York, for example, that would include not just New York City, but also Buffalo, probably Syracuse. And if the threshold comes down even a little bit further, as I think Ron and I both suspected it will, we might see a time at which Binghamton or Albany might qualify as well. Similarly, in other states of the union, right? So that's another thing that's I think especially significant about the fact that the cities are being sort of looked at in particular. Ron, there was a second part of your question that I think has slipped my mind. Can you remind me of it? I get so excited about each part that I sometimes forget.
Sure. So I wanted to transition into explaining to the folks what the difference is between, because we'll often refer to the Federal Reserve as the Fed versus the federal government. And when we think about the federal government, we're always thinking about the person in the White House and what's coming out of the White House, and why it's so important to distinguish the policy set forth by the chair of the Federal Reserve and the board itself versus the White House.
Great. Yeah. Thanks for. Yeah. Now I remember. Yeah. So the fact that this is the Fed doing it is especially significant as well for at least a couple of reasons. The most immediate reason is that the Fed is the issuer of our currency, right? As I mentioned before, you take a dollar bill out of your pocket, you read across the top, it says Federal Reserve Note. That means something. It's not a note in the sense of a note to your sister or your boyfriend or girlfriend or whatever. It's a promissory note. The word note abbreviates the phrase promissory note on the top of your dollar bill. What that means is it's a Fed liability. It's a Fed promissory note. But for our purposes, the practical significance of that is just the money is issued by the Fed. So that means in turn that if the Fed says it's going to run a facility like this to help to monetize the cities and the states, to sort of provide them all the funding they need, well, it doesn't get much better than that, right? If the actual issuer of the currency is the entity that's saying you're going to have all the currency that you need, you can't get any better than that. It just doesn't get any more authoritative than that. That's the immediate significance. The second significance to this, less immediate but still highly important, is the fact that as our central bank, the Fed has a certain degree of policy-making autonomy, a certain degree of policy discretion. It's a bit, you can sort of analogize it to the court system, right? The courts, in the courtroom, the judge and the jury are not supposed to be influenced by outside political pressures. They're supposed to decide each case on its merits. We don't have a plebiscite across the state of New York to decide whether a defendant is guilty of a crime or not. We don't tend to have, take a big national vote on whether to define for a plaintiff or a defendant in a courtroom, because it's understood that you need sort of special focus on the case at hand. And so the courts have to be, to some extent, insulated from the immediate political process, even though they're in the long term accountable because judges are appointed by politically elected leaders and so forth. It's a sort of similar story with the Fed. We think of monetary policy as something that's sufficiently high stakes and important on the one hand, and sufficiently vulnerable to sort of excessive passions of the moment, either of an inflationary sort or a deflationary sort on the other hand, that we've decided as a polity that there ought to be at least some degree of insulation between Fed policymaking on the one hand and the political process on the other. Now, sometimes it looks as though the insulation that we've given the Fed is too much. I'm one of those, I think Ron is one of those as well, who sometimes think that there might be a little more insulation than we ultimately need. But I think we all agree that some degree of insulation is a good idea, and certainly in recent years it's been a good idea. Because as a lot of you folk will remember, back in 2008, 2009, 10, 11, 12, the Congress was dominated by austerity-thinking Republicans who would have basically starved everybody of the money that was needed. They would have starved the economy of the money that was needed. The Fed, however, was happily run by people who had a much more, I think, sensible understanding of what the needs of the economy were. It wasn't, again, an ideal understanding because, as just noted, Ron and I both found fault with what the Fed did in 08 and 09. We thought it was too helpful to the banks. So we don't want to encourage, obviously we don't want to endorse any of that. But it is worthy of endorsement that Ben Bernanke, when he was the Fed chair, and then Janet Yellen after him, were both resistant to calls to be austerian that came from some Republicans in Congress. There's a similar, I think, story to be told right now. I think in many ways, as you guys know, Mitch McConnell just the other day said he thinks the states should simply be allowed to go bankrupt. And the last I checked, he's still the majority leader in the Senate. And of course, as you know, just yesterday, the guy in the White House said something similar about the states. And so that's basically austerity speak, right? Saying you states can go F yourselves. And the fact that we have a somewhat more sober seeming Fed chair, and the fact that we have a Fed that's a little bit more attentive to the needs of the states and the cities than it is to the sort of sirenic calls of austerity thinking, I think is probably good news for us right now. And so that's another sort of significance, I think, that the fact that this is the Fed has for our purposes.
Got it. So if the White House and our president is telling all the governors and all the mayors saying, you're on your own, we're not giving you a dime, you can go file for bankruptcy. And that's one hand. And then but the reserve is saying, no, we've already thought this out. You guys are the frontline defenders of our democracy, of our people. We will put in the financing to make sure that not only you survive, but you get all the necessary funding to make sure that your people are protected. If you were in a position, if you're the executive leading the recovery, should they be going to engage in a fight with the person that's clear, that's being very clear, we don't want to give you a dime, or should we go engage with the Federal Reserve, who's ready and willing to print new money, for lack of a better word, as much as we need it to make sure that we get out of this fine? I mean,
Yeah,
it's a
my
rhetorical question.
inclination is if it's a choice, if you really kind of have to choose where to kind of focus your efforts, and you have to choose one or the other, I think the proactive and affirmative thing to do is definitely to go after the Fed and say, let's get this thing up and running, let's get it fully operational, let's get those funds flowing as quickly as possible, and the sooner we do that, the more lives we save, but also the sooner we realize what kinks are still in the system, and hence what more has to be done to kind of iron it out and to sort of optimize it. So if it's a choice, that's what I would recommend, particularly given the fact that no matter how hard we've fought in the Congress over the last 3 or 4 years, doesn't seem to have done much good. Now, of course, it's a different story if we're talking about the polls in November. Obviously, we'd like to change this Congress so that next January we have a different Congress. But for the time being, right until then, if we have to choose, I think that's where our efforts are best directed. If it's possible to do both, right? If it's
Sure.
possible to kind of continue lobbying efforts to get the Congress itself to act in the way that it should, if it's possible to, sort of make other Republicans to repudiate what Mr. McConnell has been saying, repudiate what Mr. Trump has been saying, well, then great, do that too, as long as it's not sort of taking away, appreciably taking away from the effort and energy that you're able to devote to getting the Fed plan sort of fully up and running and fully operational. But otherwise, it's fine to do both. In that connection, it's worth noting that even though the facility was officially announced on the 9th of April, and even though we're now up to the second term sheet almost 3 weeks later, there's still not a single dollar that has flowed from this facility to a city or a state. And the reason for that is it's taking a while to get it up and running. And that's partly in turn a function of the fact that it's a relatively small number of people or personnel that the Fed has to work with to kind of get this thing going. But I can definitely tell you guys firsthand that they're basically working 24 hours a day to get it up and running as quickly as possible. But the fact that it's taking that long, and already has taken that long, suggests to me that where I think you were going with this, Ron, is even more compelling, right? It's all the more compelling. We really have to get this thing flowing immediately, because it's been 3 weeks already, and literally people are dying every day, right? I mean, it's literally the case that some of this funding is going to save lives. It's actually going to enable certain remedial efforts to be undertaken by cities and states that will definitely literally save lives.
Right. Now, I think the last question, Bob, I think people are also, they don't quite understand the difference between what a loan is versus a possible grant. But in the sense of traditional loans, this doesn't feel like we're going to a bank down the street and borrowing, uh, $20 million with 3% interest rate we have to pay back every other quarter. It seems like when we're dealing with the reserve, even though it reflects similar terms of traditional loans, uh, I almost feel like it's more of a nod and a tribute to the localities that we're here. We're not trying to, make you into debt and hold you beholden to the federal government. Now that you've taken our money, we're gonna own you for the rest of humanity. I don't think that's the mindset or the approach of the lending mechanisms that are in place. Am I correct to assume that?
Yeah, you're exactly right. There's a short playing version of the answer to that, and a slightly longer one. I'll start with the shorter one. The shorter playing version of this is that the Fed has never sent anybody out to kneecap somebody for
Right.
not paying up their debt. It's not a loan shark operation.
Right.
It doesn't go out and sort of say, Rocco's getting impatient, hand over the money sooner rather than later. It's just not the way it works. Typically, a Fed lending facility is a very generous facility. It's really more. It's a bit like, how the analogy I'm often tempted to draw, and you might like this especially, Ron, given some of your constituents. And actually, maybe somebody can tell me the name of this. My understanding is that it's a common practice among some residents in Chinatown that when a man and a woman first get married, their parents will oftentimes provide some money for them to buy a house, to make a down payment on the house. And the understanding is that if they're able to pay it back at some point, they will. But if they're not able to, they don't have to. So it's sort of something between a gift and a loan. And I think the closest analogy that I can come up with in sort of ordinary life to the way the Fed lends is that it's a bit like a family lender. It's a bit like kind of your parents, your grandparents, your aunts and uncles making a kind of loan slash gift for you to make a down payment on your house when you get married. It tends to the whole thing that, I mean, the very motive that prompts the loan in the first place is such as to make it seem ridiculous to the Fed to sort of be harsh about enforcing it or treating you as some kind of a debt pay-on or a sort of a dependent forever, or as a kind of an indentured servant or anything of that sort. So that's the sort of short playing version. The slightly longer playing version is just to say that if you look at any previous facility like this that the Fed has offered, the Fed quite typically characterizes it as a liquidity facility and always says, yeah, it's a short-term lending facility, and yet the loans always end up being very, very long-term, right? So the balance sheet of the Fed, that's to say that the total asset portfolio, hence the total loans that the Fed extended back in 08 and 09, there was a massive expansion, right, of the asset portfolio of the Fed, which is just to say that the total loans outstanding of the Fed. And the Fed back in 08 and 09 said, this is only temporary, this is just a brief liquidity support sort of thing. Well, and it'll shrink back down. Well, the Fed's balance sheet has not shrunken back down. It's still huge. Similarly, when Fannie Mae was taken under federal receivership in August of 2008, it was said, oh, this is going to be temporary, you know, it won't stay there. It's still in federal receivership. It is a de facto federal agency again. That's, I think, the way the Fed is looking at the cities and states now. It's just saying, look, as long as you guys need federal funding, you shall have it.
Right. Well, thank you. Thank you for the clarity. It's very helpful. We're a few minutes past our scheduled time. We're going to go to our friends to see if they have any questions before we wrap this up. David, Rachel, and Tony, are there any questions? Or anybody in the room, in the Zoom, if you want to ask a question, please feel free to do so. David, Tony, Rachel?
No questions on my end yet.
Okay.
No questions here.
Okay.
No questions on Facebook right now.
Okay, good. Okay, well, I think we pretty much covered everything thoroughly. Thank you, Professor HOCKETT from Cornell. So also in this new facility, there are no guidelines or restrictions from us being able to leverage the $20 billion, meaning this could be an amazing opportunity to introduce and finally execute public banking in the state of New York. This is something that Bob and I also have talked about and will be implementing into our new legislation to set up a commission to do precisely that, and also set up the infrastructure to go get this money from the Federal Reserve and work directly with the Federal Reserve, the local New York Fed Reserve, which we have not done so yet. Again, we don't need legislation to do it. The governor can tomorrow sign an executive order and direct every one of his budget-related and financing agencies to start liaising and interacting with the New York Fed Reserve to make sure that we are in a position to get this money instead of going directly to cutting social programs, education, and healthcare programs. Now, if this new money, if the governor were a CFO of a company about to go under, and some family lender comes along and says, we can give you unlimited funds, and we probably won't even collect that money until you really want to pay us back, what CFO in their right mind would not take that money? So that's kind of where we are with the state of New York. People are not focused on the right solution. We're trying to pick a fight with the president when there's a whole pile of money that we can get from the reserve. And I would have to think, if we continue to take that path, there only has to be one reason why we're not getting out of an austerity mindset. It's because we are doubling down on austerity, which means we want to starve our classrooms for charter schools to take over. And we want to starve our hospitals for private equity firms to take over. And nursing homes, it's already been taken. Private companies already took them, which is why we're seeing the outcome as that we're seeing now: understaffed facilities that do not have PPE, that are profit driven, and that are completely privatized. If we want more privatization, that is the path: more austerity budgeting or more cuts. If we want to get out of this and we want to center our policies around helping our people and making sure that we are funding all the required resources to make sure that everyone is fine, not only fine, but can actually thrive economically moving forward, we have to work with the Federal Reserve to secure the $20 billion. So we have a lot more, but today was really just to cover a very complex topic. I know, Bob, you this is this is your whole lifetime of doing this, but for the rest of us, this is very dense. And as I said earlier, the moment we hear these terms, a lot of people's filters go up. But we really need to focus because if we don't get this right, a lot of people will be suffering in the near future. Thank you all for tuning in, and thank you, Bob, for always your time.